Hi, my name is Arun Rafi and I work in the stable bonds team. The first video of the series will broadly cover the basics of bonds. So the first question, what are bonds? Bonds and fixed deposits are very similar assets. In FDs, you make a deposit to a bank for which it promises a return and principal after the tenure. Think of a bond like a deposit you make with a company or the government, and in return, it promises to give you fixed interest, it could be monthly or quarterly, and also pay you the original amount which was the principal deposit at the end of maturity. In fact, both FDs and bonds are called fixed income instruments, which means that they will not be related to the stock markets whatsoever. Now, who issues bonds? The broad classification of issuers are governments and corporations. Governments include central government, state governments, and even municipalities. Corporates can be private companies, public listed companies, and even big conglomerates like Tata, right? Now, why do these corporates issue bonds? Generally, a company has 2 to 3 ways to raise capital, if you see. First, issue stocks and raise capital. Second, take loans from banks. Third, raise it via bonds. Only a few companies are publicly listed and, even over there, issuing more stock means diluting ownership. Companies do raise it via banks, but generally these are long-term requirements and have very strong clauses attached to it on what the company can do with the money or not. Bonds, on the other hand, give the company a lot of flexibility to raise capital without the need to dilute equity, to invest in growth and infrastructure, especially for short-term and medium-term needs. While central governments can keep printing money, that's not the best way to meet the capital needs. Government bonds are raised by central governments, state governments, and municipalities. And they can be for different purposes. For example, a commonly heard term you will see is treasury bill. Treasury bills are issued by the central governments, which helps them meet their short-term requirements, which is upcoming. These are generally 90-day, 180-day, 364-day treasury bills. Then there are bonds issued for infrastructure needs, right? Like bonds issued by National Highway Authority of India and other such infrastructural companies. You also have bonds that are used for a particular state's development, called as the state development loans, right? Finally, you also have a term called municipal bonds, like Indore Municipal Corporation, that raises bonds to make their city better and cleaner. How does a bond weigh in terms of returns? Typically, government bonds can start somewhere from 5 to 6% and go up to 8 to 9% in case of a state and a municipal bond. Similarly, corporate bonds start from somewhere around 8% and go as high as, let's say 11 to 12% for well-rated bonds. Now, how does a bond do payouts, right? Generally, there are 2 components of a bond payout, the interest payout and the principal payout. Typically, popular bonds give out monthly interest payments. Then there are a few who do quarterly and annually, but mostly it is monthly. Think of it as a loan that the company has taken from you and they are giving EMIs to you. Then there is the principal payout. This happens in most cases towards the end of the tenure, which is called as the maturity date. There are a few bonds which give you principal in part during the tenure, but majority of bonds give you principal at the end of the tenure. Who regulates these bonds? Bonds are regulated by the Securities and Exchange Board of India, SEBI. Similarly to how a company issues a document called the DRHP document before IPO, a company raising bonds has to submit a document called the Information Memorandum to get the approval of SEBI to raise money via bonds. Now, what happens through this is any regulated bond is thoroughly gone through the process of due diligence before it gets approved. There are some bonds that are unlisted, so make sure you always look out for bonds to invest in which are regulated and listed. What should you do to invest in bonds and how does it work? Firstly, you need to have a demat account for you to invest in bonds. It is a one-time KYC that you need to do, which includes your basic Aadhaar and PAN card verification through DigiLocker. KYC can take approximately 3 to 5 minutes and get approved almost instantly. After that, you are free to invest in any bond of your choice. A demat is needed as a proof of investment, right? Similarly to how you book an FD and you get an FD receipt as the proof, Similarly, the proof of an investment in bond is the units being credited to your demat account. Bonds are generally bought in units. A unit price can start from rupees 100, rupees 1000, 10,000 or a lakh. This is an important difference between an FD and a bond, right? So for example, if a bond unit price is 10,000, you can buy it at 10,000, 20,000, 30,000 and so on multiples, not 15,000. Once you invest, the order is placed and settled through NSE or BSE. Typically, the unit settlement takes T+1 settlement window. That is, if you invest in a bond on Monday during 9:30 to 4:30, the trade gets placed on the same day and gets settled on Tuesday. If you invest, let's say, on Saturday, the trade gets placed on Monday when the market opens and gets settled to your demat account on Tuesday. And the price you see at any point is based on the settlement date. So you're not losing out on your interest when the settlement happens. Typically, you can invest in a bond through any bank account associated with you, but the bond interest payout and the principal repayment always happens in the demat linked savings bank account. How liquid is a bond? Can I sell it before the term ends? There's a great difference between an FD. In theory, you can sell a bond because it lies in your demat account, right? But in most cases, it is not practical because there is no buyer on the other side. Bond markets are not as liquid as the stock markets. And hence, while you might place a sell order, it is not always mandatory that someone buys on the other side. It's generally best to invest in a bond only if you're comfortable locking in your money until it matures. This brings us to the end of the first video of the series. I hope you found this really helpful.